The Australian equity market had a steady quarter, with the S&P 300 index total returns rising by 0.7%. Local economic data was generally soft, with recent interest rate and tax cuts yet to have material impact on economic activity. Despite this softness, bond yields increased over the quarter, with the Australian government 10-year yield rising 35 basis points to 1.37%. The Australian dollar strengthened against the US dollar. Prices for key commodities also tended to rise, consistent with a more favourable global outlook. Looking at performance by sector, healthcare was strongest, followed by energy and materials. Financials was weakest, followed by consumer staples and A-REITs. The Maple-Brown Abbott Australian Share Fund, the wholesale units on an after-fee basis, produced a total return of -1.5%, underperforming the market by 2.2%. Our overweight holding in Virgin Money UK, with its UK banking interests, was a significant positive contributor to performance. The stock was seen as one of the key beneficiaries of the Conservative Party's resounding UK election victory, and with it the reduced likelihood of a no-deal Brexit. Our overweight holding in Caltex performed very strongly. The company issued a positive trading update in November, and the stock further benefited from a subsequent takeover offer from Canadian convenience store operator Couche-Tard. Our decision not to hold CSL was the largest negative contributor to performance. The stock benefited from some positive news flow around its core plasma markets and from a continued rotation into growth stocks. This ongoing outperformance is somewhat surprising, given the significant increase in bond yields over the quarter, which should disadvantage growth stocks with long-dated earnings. CSL is now trading on approximately 41 times forward earnings and has ever more challenging growth expectations built into the share price. Our holdings in the major banks contributed negatively. Whilst we were modestly underweight to the poorly performing sector, our holdings were focused in the worst performing banks, including Westpac Banking Corporation and National Australia Bank. Commonwealth Bank of Australia, to which we are significantly underweight, faces similar challenges to the rest of the sector, but continues to trade at a significant premium to peers. Our overweight holding in Helios also underperformed, reflecting disappointing earnings guidance at its AGM and some soft industry data. A year ago, markets were under significant pressure as investors worried about everything from global trade tensions to Brexit. Domestically, we faced a federal election where the opposition, with a string of investor-unfriendly policies, was favoured to win. With the resolution of most of these concerns, the Australian equity market has delivered a very strong performance, with the S&P 300 index total returns delivering a return of 23.8% for the year to 31 December 2019. This is the highest calendar year return since 2009, when markets were recovering from a global financial crisis and an approximate 40% fall in the prior year. Despite the strong returns of equity markets, value managers have in general faced very tough conditions, as corporate earnings growth has been very modest during 2019, and the key driver of returns has been price earnings multiple expansion. It is true that we have expected some reversal in this trend for some time, but whilst there have been examples of these sorts of stocks falling by the wayside, the larger and most widely held names have continued to advance. Given the extraordinary moves seen in key names during 2019, we would be exceptionally surprised if there was not a correction during 2020, which should provide a strong tailwind for our performance. In our view, this is the time to adhere even more strongly to our value disciplines, and in so doing, we remain very confident in the outlook for value.